Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. In this video, we're going to be talking all about retirement planning. How do you know where to start with retirement planning?
I think the best place to start with retirement planning is what you would consider to be a retirement planning projection.
Okay.
So you take the people's current assets, you take their current spending patterns, and you grow out the assets on some investment return amount, and you inflate out their need, their monthly spending, you grow it for inflation over time to what it would be at the point where they say they'd like to retire. And you look at things like Social Security and pensions and other sources of income or assets that might be there at that point. And you then keep on looking at that all the way out to some point in the future when they would both likely have passed away, and see whether or not you still have a balance. Do you still have money? Or did you run out of money 5 years into retirement or 10 years into retirement or very, very close to the end, let's say. Okay. So you start with that because what you want to know is, are we on track? Are we saving too much money, a rarity, or are we saving too little money? And once you know that, then you can start to plan for any changes in action that make sense based upon that.
Okay. So how would you start to plan, supplemental items so that you can increase your assets by the time you are retired?
Okay. Well, the simple first things to do are, try to increase your savings, or, look at your job prospects and see if there's something where your income could be higher, so your savings could be higher if you need more money later on.
Yeah.
Okay. But it's a very simple set of variables. You can retire later. You can save more. Assuming that you can't retire. If it says you can't retire when we assumed, okay? You can retire later, you can save more, you can try to get a better investment return after taxes, or you can die sooner. And I have yet to meet anybody who wanted to die sooner, right?
It's a bleak option.
Right. So that's really what you can do. Now, before we say, hey, you got to save more money, or hey, you got to wait to retire till later, we want to look at that asset efficiency option. We want to see if there's something that we can do to get them closer to retirement by being more efficient with what they're doing rather than trying to change the other variables.
Now that we know the important factors that go into retirement planning, are there any retirement-specific plans that we can look into or accounts that we can start?
Yeah, absolutely. In fact, there are a number of them, and it's so complicated that it's difficult to really learn them all. So let me try to make it just very broad brush and simple.
Just the basics,
okay.
That's all I need.
Okay, good. So first of all, make a distinction between, generally speaking, plan types that you would find where you work for a company.
Okay.
Versus plan types
like a
that
company benefit
if you have to create your own plan.
Okay.
Because you are an independent contractor, you have your own business, something like, and maybe you don't have any or many employees. Okay. So on the company side, you're generally going to have, the most common type of plan is called a 401k plan. The 401k allows you to deduct money from your own salary and put it into the plan.
Okay.
Anything you've been put in the plan is yours, and it's always yours. And anything it grows to is always yours. Doesn't matter how long you work there or not or anything else. There are two general types of 401k plan. The first would be considered a traditional 401k plan. What that means is that when you put the money in, you get an income tax deduction. It lowers your income taxes when you put the money in. The nice thing about that is that you're able to save more money in the plan than you for the same dollar, basically, because some of the tax savings helps you pay for the money that you're putting into the plan. The downside of it is that later on, when you're past age 59 and a half, when you're retiring and everything, okay, when you take money out of the plan, it's all income taxable to you at that point, okay? The alternate to that is the 401k, the Roth 401k, ROTH, okay? With a Roth 401k, you don't get a tax deduction for what you put in. Both of the plans have tax deferral while the money is invested. You don't pay anything on no taxes on whatever happens along the way, income, interest, dividends, capital gains, etc. But after age 59 and a half, if you retire and take money out of it, you pay no income tax. And not only on what you put in initially, but on all that it has grown to over all that time. So that's very powerful, especially for younger people. So there's a kind of a calculation that typically can be done, and there's some online calculators.
Yeah.
But you can put in some assumptions, and it will tell you, hey, you should do a Roth 401k, not a traditional 401k, or vice versa.
Yeah.
So that's the 401k side of traditional companies, company employers. The next thing is a profit sharing plan. And what a profit sharing plan means is that the employer is taking a chunk of money, typically from its profits, and is saying, I'm going to disperse this money and allocate it among my employees as a means of holding on to them, as a means of rewarding them for what they've done and helping them towards their retirement. When that's done, the money that gets put in is tax deductible to the employer. Okay. But when it comes out, it's taxable to you, to the employee. Okay? So it's not like the Roth.
Yeah.
Different from the Roth. You'll have to pay income taxes on that money to the government when you take it out. Okay. There's one more company type plan called a pension plan. And you may have heard of this. Yep. You can also have, by the way, a profit sharing and a pension plan if you own your own company, but I'll come back to that. A pension plan basically means that when you come to the point at retirement, you don't get a big chunk of money. What you get is an income for life. Okay. An income that's guaranteed for life. Okay. That really barely exists anymore. There are very, very few companies that offer pension plans anymore. So most people have to make a profit sharing and these 401ks plus their own savings and Social Security. That's usually what they've got to make it through to retirement done. So, but that's the company side. Okay. Now, if you have your own company or you're self-employed, you don't have any employees, you're kind of on your own, there's similar options, but a few different. There's a Roth 401k, yes. There's a traditional 401k for one person, but they're very rare because there are some, it actually costs some money to administer those, so they're a little bit more rare.
Yeah, when you don't have the profits of a company on your back to help offset that.
Right, or if you could get to the same place for a smaller cost, you want to do that. Yeah. Okay, so you can have the profit sharing type. You can also have what's called a SEP IRA, a Simplified Employee Pension IRA. So it's just like an IRA, but it's a pretty decent amount of money you can put in. And so some self-employeds, it makes sense for them to just have this SEP IRA arrangement instead of even a profit sharing plan, for example. You can have a pension plan if you're self-employed. Again, it's rare. Pension plans make the most sense for people who are older, just by the way that they work and the way that the amount of money you can make in deductions with it and stuff for the contributions. So most pension plans are only put together by people who are older. So if you have your own company, it's really the Roth and traditional 401ks, which again still are good examples. The SEP IRA. There are traditional and Roth IRAs also.
I was going to ask what that was next.
Traditional and Roth IRAs. So that's just the straight traditional individual retirement account. The Roth IRA is just like the Roth 401k. You may not be able to put as much money into it as you could to a Roth 401k, so you kind of have to look at the options there. Okay. But same thing, you don't get a tax deduction for putting it in, but it all grows tax deferred, and whatever it grows to, you get tax free after age 59 and a half. So it's a very valuable tool for younger self-employed folks. Those are really the self-employed options.
Okay, I think that covers a lot. Now we talked a little bit about how to maximize your savings for retirement. I know we talked about company matching. I'm wondering, are there any investment strategies that you would recommend specifically for retirement?
Well, I think the most important thing for investing towards retirement is to make sure that you are matching risk and reward together. So what that typically means is having a strategy similar to what we've talked about in our separate investment videos, which is to say where you have brought the risk of what you're doing down closer to market risk. So I wouldn't advise people to have in their, and I'm not giving advice now, but you wouldn't find someone recommending one technology fund for your whole 401k plan. There's just too much risk versus the reward that you might potentially get from that, and compared to something that's more broadly based, which has less of a risk to it, and would just be a little wiser to do. So it's not so much that you can do a better job investing necessarily, but you're making sure that you're managing risk and making the risk and the reward in equilibrium, as opposed to taking outsized risks or frankly underinvesting. There are people who, they're 30 years old and they're invested in money market in a 30-year 401k plan investment vehicle. So that's too conservative in all likelihood. Most advisors would probably say it's too conservative. So just making sure that you're investing wisely relative to your age, your risk tolerance, and the options available to you within the plan.
So you talked about how to strategize to make your retirement go as far as it can for you. I'm wondering, how do you actually calculate all this information? How do you see what you're looking at? How do you see any changes over time?
Well, there's something called a Monte Carlo simulation that we financial planners typically will do for clients. And if you remember earlier, I talked about a variety of variables and putting that into a computer program and having it tell us whether or not you can get there or not. Once you've looked at potential changes to the way that you're doing things, you'll put it back into the program, but you're probably going to look at this even more broadly once you're kind of settling on the way that you're going to go forward. A Monte Carlo simulation basically means taking all of those variables and changing them into all kinds of other variables and projecting that out and doing it like 1,000 times or 2,000 times and seeing what percentage of the time you actually successfully can retire. And it gives you an idea of the risk involved in your particular retirement plan and situation. So if only 30% of the different scenarios work out that you can retire, you may probably have to do some more work. If 70 or 80% show that you can retire, that's a pretty good shot that you're on track and you're doing pretty well. If 100% obviously show it, you're fine. Okay. So the final step to me is always doing the Monte Carlo simulation for people and showing them what the level of risk really is that they're going to get there or not get there. So, that's the way that I approach it. I think a lot of professionals approach it that way. And Monte Carlo has become pretty much a state-of-the-art and standard thing that's done to just do a final check as to whether or not the whole situation looks like it works.
Okay. Well, retirement sure is a complicated topic, is it not?
A lot of different aspects to it. There's no doubt about it.
There's so much to consider, but hopefully with the help of this video and maybe using that simulation, you'll know what your options are and know how to make the most of them. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.